All right. Well, why don't we just get started here? 7 o'clock officially. I'm sure a lot of people are going to be joining us still, but we just hit record. So yeah, we'll get going. Anyway, thanks everyone for joining us. We wanted to do this for a couple reasons. One reason is, we want all of our investors to have as much transparency into what our business is, what our thoughts are, how we're moving forward. Basically just want our investors to understand any workings of our business that they may be interested in. So we thought this would be a good idea. Let's recap 2022, talk about kind of where the market's at today, where it kind of has been. Obviously, we're seeing that we've gone through a lot of transition. 2022 was a kind of almost a tale of practically 2 years, right? It was, 2022 started out red hot and ended out ice cold, right? Totally different times here. So we wanted to really just recap 2022, what Endurus did, and then bring us into 2023, really what we're looking forward to, what we see as, things to really look out for in the market, but potential opportunities too to come. Endurus is really committed to continuing growth, as long as it's really strategic growth, as long as it's smart, well thought out growth. We want to continue to grow the company. One of the nice things about Endurus and how we're set up is that, we don't have to buy deals to continue to keep the lights on. With how we're set up, we can just take our portfolio, continue with where we're at, continue to perform on the properties, improve those performances, and not buy. Now, that's not ideal. That's not what we would like to do. What we would like to do is continue to grow the company, of course, and continue to provide investors, good returns. So that's the goal, obviously. But just knowing that we don't have to do that, I think, is kind of a nice position to be in. So that was, a big reason why we wanted to do this. Another reason is because a lot of people ask us a lot of questions. And so we want to provide as much value as we can, whether you're an investor or not. You don't have to be an investor to be here, of course. But, we just want to provide people good information on where we see things going and where we've been and where we see things going into the future here, and how we're preparing for, what could potentially be some exciting times for investors, and what could potentially be some challenging times as well as we move forward into 2023, 2024. I think Drew mentioned earlier today, we were talking about, this very same topic, and, typical recession, whether, we get into a deep recession or not, we'll see, but typical recession only lasts a short period of time, typically less than a year. So we'll see where we go, but I think there's some exciting things potentially coming, some things that might disrupt a lot of people's businesses, be maybe not so exciting for definitely some of that as well. So, all right.
Todd, you know what's exciting about this week though?
What's that?
You know what this week is? This week, I believe, is our 1 year anniversary of the launch of Endurus Capital, because we came out, I think, about mid-January.
Okay.
So
it
that's
feels like it's been so much longer because we've been doing business with each other for so long. But officially, Endurus technically wasn't around. Is fairly on its infant stages. But
yes,
it feels like, man. Collectively, we've been doing business for over 30 years. Well over 30 years, and together we've been doing business for, whatever, 5 years or so. So it doesn't feel like it's been a year.
It doesn't.
There's been a lot of phone calls over this year.
Yeah, there's been a lot of phone calls, a lot of Zoom calls, a lot of, definitely some face-to-faces. It hasn't been the lack of meetings, that's for sure.
And so a website. We got a website. And
we got a website.
All the fun stuff.
A t-shirt and shirts. Hey. So we're going to just talk quite a bit about reflections on the real estate industry, economic update, credit markets, and then we'll dive in a couple of the acquisitions we did and some of our markets, and then really just the final thoughts on, hey, where's 2023 taking us, and what are we excited for in the future. So that's how it's going to roll. First things first, most of you here know who we are, so I don't want to spend a lot of time on that, but we're just committed to our partners, our residents, and our communities. We believe that if we serve, kind of those three pillars, those three prongs, that we're going to be successful as a company. Profits will come if we focus on those three kind of areas. And this kind of just as a, this Drew's wheel of fortune here. So, Endurus is a company that has to work with, when you think of real estate, and you could put yourself in here if you're a real estate investor yourself. You put yourself in the Endurus spot, and you have to work with all these people. So our job is to really create really solid relationships with brokers, with contractors, attorneys, investors, lenders, and so on. So our job is to create really solid relationships with these key areas of focus, and some of that we're going to try to be bringing in-house too as we grow. But the more we can, create good relationships, build upon those, form new relationships, and to make those positive connections, and then show our, the results that we have to those connections. Say, for instance, a broker, when we perform on a property, they're more likely to bring us a deal, right? If they see that we performed on a property with maybe one of their competitors, they're going to bring us the deal because they know we can close. Or for instance, that same person, they're going to go, hey, Endurus was easy to deal with. They were quick to close. They're super easy to deal with. They did what they said they were going to do. We want to do business with these people again. They get back to us really quickly. We send them a deal. They say no. They say yes. They tell us why. That's who we want to do business with. And so if you're in that spot, that's how you want to be as well. You want to build these relationships. You want to be easy to deal with. You want to communicate well. Those are the important things. All right. And so again, I don't want to spend time, but you got Matt Brawner, myself, and Drew Whitson, and we'll be talking here. So 3 owners of Endurus. And I would just want to point out, so Zach Heidi's our director of acquisitions. I want to point out Daniel Simpson. So we brought Zach on at I guess it was spring of 2022, but Zach had been working part-time for us, really underwriting deals and helping us in that aspect. And so he's really helped us bring deal flow into Endurus, bring a lot of deal flow in and help us analyze that deal flow, communicate with these brokers. And so that's been a huge kind of big lift for our company, is to be able to get that deal flow. One of the challenges, there's two challenges, more than that, obviously, but two big challenges is finding deals and then finding money. You either have too much money or too many deals. And so we brought Zach in to hopefully get us too many deals. So we have to start saying no to deals, and we can then just really pick the best of the best of the best and then feed those to our investors. And of course, that's one of my jobs, and is to find the money so we can close on all those awesome deals. But then we brought Daniel Simpson in this year as well. And that's been very instrumental for our company to bring in Daniel. He's a director of asset management. He comes with 35 years of experience. He's been in the industry. He's seen a ton of things. And it's amazing as you bring him in, a lot of the just insight that he has, how he can talk with the property management companies, the on-site staff. Our success in the properties is because of solid asset management. And so, prior to bringing Daniel on, it was Matt, Drew, and myself. And I would say we're pretty smart guys and we kind of know what we're doing, but bringing Daniel with that amount of experience has really helped us with our asset management, really helped us be able to direct our property managers in the proper direction and point the needle, due north, right? Instead of kind of being all over the place. And really Daniel has streamlined that process and made it a lot better.
I think one of the great things, Todd, that Daniel brings to the team is he gets there in person, and we see better results every time we have ownership shows up, and he represents ownership.
Yeah.
And he does a great job with staff development as well. And those are things that you and I haven't done, work with, developing individually managing leasing managers, but he has. And so he can really bring a lot of tactical tools and advice on site every time he arrives.
Yeah. I mean, we've managed our own properties, right? We've been a part of this real estate for a long time, but we haven't been boots on the ground like Daniel has. And so just that level of knowledge has been extremely helpful. Your property really lives and dies with your on-site property management. And so if you don't have very good on-site, you're just not going to do well. And so Daniel's able to direct that the right way. And again, it's been a huge benefit to the company to have him on board. And then a lot of you who've dealt with, us as far as investors, know Tracy as well, and brought her on over the last couple of years. And she puts all our decks together and does a lot of the back end investor relations. All right. So next thing we're going to hit on is the multifamily kind of industry update. Endurus is a value add real estate investment company, but our bread and butter is certainly multifamily. Now, if you've been an investor or you've been following us, you understand that we also like other asset classes. We'll dive in a little bit to those other asset classes. We closed on a retail building this year. We're really excited about that building. I'm going to do a deeper dive into that in a little bit. I closed a industrial/office building year prior. Are having great results with that. Really excited about that, and some assisted living as well. So we'll dive into some of those other asset classes a little bit, but today is going to be our main focus, mostly multifamily, because that's really our bread and butter. So from there, Matt, I'm going to let you jump in and dive us in.
Awesome. Thank you, Todd. So as Todd said, what we're going to do is talk a little bit about what we're seeing in the multifamily sector, and then we're going to put that into a broader context of the economy as a whole that Drew's going to comment on later. But as we specifically look at multifamily, one of the reasons that we continue to go back to multifamily are the fundamentals. So as you look at being in an inflationary time period, we like the fact that at its basic level, leasing apartments, those leases can reset every 12 months. So it allows us to capture additional income for our properties. And you also see certain expenses related to properties lag a little bit. So we're not in the middle of some of the price changes that you would see in other industries. And then, as you've heard us talk through before, we are providing a basic need, and the need is only growing. We have, at this point in time in the United States, the largest percentage of the population serving as renters. And you're seeing what's most important, and we saw this bear out during COVID, is that this population is willing to invest into where they live. We're going to talk specifically which multifamily sectors that we like to focus on, but this is really important because people not only need a place to live, but they are willing to pay for it, as you've seen there with tenants expressing a willingness to pay higher rents for increased amenities and higher end finishes. No one, I think, can tell you exactly how many new units as you look at, and it's something you've heard quite a bit here recently. Hey, I see a lot of supply coming online. Does that make you guys nervous? We are seeing new supply come online here. I like to remind people of two things. One, we're still under supplied. So if roughly 1 million units come online across the country this year, we're still a few million short, and then you're going to see that grow year over year. And obviously that doesn't impact all markets the same, and we'll be able to speak to that more as we get into our individual markets. And then you'll see us talk through some of what we're seeing in rental trends here as well. At least in my lifetime, COVID hasn't had anything, or has had an effect that has been difficult for us to wrap our minds around when you think of just how much it reset things. And so what we're seeing is a lot of demand pulled forward, and you're going to hear us talk a lot about regression to the mean here across multiple sectors of the multifamily industry. Todd, let's go to the next slide. So first and foremost, talk about regressing to the mean here. As you saw, 2022 kickstart, phenomenal demand, and we were looking specifically at people coming in the front door. So this, if any of you guys follow Jay Parsons, he's really a thought leader in our space. He's posted graphs like these before, and RealPage is a software that a number of apartment operators use. And so this is what's driving that, and we're able to see, based on their entry cards, how properties are doing at being able to fill vacancies. And we did see a drop there. Now, what's important is that, and I spoke to this earlier, we saw such phenomenal growth in 2020 and 2021. There are a lot of people who just assumed that that was normal, right? That rents are going to consistently go up 9, 10, 12% year over year, and that you're always going to have a line out the door for every single vacancy that comes online. And the fact is, that's just not true. What'll be really important is, yes, we've seen a slight dip in Q3 there, which is what that marks in September of 2022. But as we scale out, and you saw this even during the great financial crisis, where we believe that there is still a trend that shows that rents have increased over time, and that we are seeing ourselves come back to the trend line here. And there's some other things that we believe point to this. If you go to the next slide. So we talked through where we were at with absorption. We saw record levels of absorption where there were so few units brought online, and that once COVID hit and you had so many sources of equity temporarily dry up, or it was difficult to even find people to work, that you saw projects be delayed. And now, as things have accelerated forward, you are seeing them come online. As a whole, as you look at investment in the multifamily and apartment industry, it's positive to see new supply, because there are ways for those of us to benefit. That creates a value add opportunity, but we monitor it because it does apply a short-term pressure there. And so, yes, we are dealing with higher supply right now. We don't believe that there's anything that shows that we're going to be oversupplied, specifically in the markets that we look at, over the long term. So moving forward again there. So this is one of the data points that I was referring to in terms of, hey, are we regressing to the mean? How are the fundamentals of our business operating? So yes, units as they turn over are sitting vacant for a longer time. No question about that. And you have seen markets pull back on rental increases, but we are not seeing residents turn in their keys in droves, right? There aren't people coming in saying, I can't afford this rent, I'm moving home with mom and dad, and we're not seeing vacancy skyrocket there. We haven't seen that with delinquency or collection rates. And so those are really, really important as you want to put into context anything that you're watching with this industry. And then for those of you that have been involved in multifamily, you know that no matter the market, especially here in Minnesota, where it gets so dang cold in the winter, there is a seasonality to our business. So it's certainly not fun for people to move when, like here in Minnesota, it's going to be negative 10 degrees this weekend. And so there is much of what you're seeing coming off of record growth, hitting a seasonal point to then be able to evaluate where we're at now. So let's go to the next slide there.
Can't wait for negative 10 degrees. It's going to be fun.
Outdoor hockey, Todd.
Yeah, there you go.
So what we want to do tonight as well, updating you on what we see in the market, but then talking through how we're responding to it as well. And so, yes, we are watching affordability, because obviously it's not good just to raise rents if no one can pay those. And you want to be able to monitor where your residents are at to ensure that you're serving a customer base that can afford the product that you offer. And what this shows is that inflation is a regressive tax. It impacts residents in different ways. And so as you look specifically at residents in A and B class properties, well, those incomes have actually outpaced inflation. And so what we see here is these residents have more staying power. One of the things that I had in my mind when I first got into this business, and Todd touched on this today for any of you who were able to attend the North Star Real Estate conference luncheon that we had, I always thought that in a time of a recession, tenants or residents that live in A-class properties are going to step down to B-class properties, and those that are in B-class properties are going to step down to C-class properties. I actually don't believe that's true, and I think this is one of the pieces that underscores it. We know that people get accustomed to a lifestyle, and we also know that when recessions do hit, they don't impact all demographics equally. It is the workforce housing that most often gets hit the hardest by recessions, that is most susceptible to losing their job, and that has the least amount of margin to be able to cover other increases. We're not just talking about rent increases. Obviously, if somebody's paying more for gas at the pump, if they're trying to buy a carton of eggs for whatever they're going for today, $8, $9, $10, well, that's just reducing the amount of money that they have to be able to pay their rent. And so as we look at this, we then say it's a better opportunity for Endurus and specifically for our investors if we are investing in A and B class properties, because we can invest for staying power, right? We get a greater margin, we get stronger cash flows so that we can provide better, more predictable returns over time. And we'll get into this a little bit more as we talk about what we look for in evaluating properties. But a lot of you who've invested in real estate familiar with what's called a cap rate. And what we see is that there's not the difference that there should be between A properties to C properties, right? You should be paying more of a premium than you are right now for these better property types. And so this is why we're so focused here. Let's go on to the next slide.
Think about a gallon of gas, for instance. If it takes you $40 to fill your tank and you make $40 an hour, you have to work an entire hour to fill your tank. But if you're making $15 an hour, right, you got to work a lot longer to fill your tank. So that's just an example how quickly, you know, it erodes, your income erodes when you've got inflation. And when you got economic, headwinds coming at you, that's why that, hey, A class to B class to C class just isn't true. And history proves it. You know, if you go back to recession after recession after recession, you can see that that's just not true. That never takes place. And so that's, we sold a lot of C class properties, and like Matt said, moving into more stable markets, being A class.
So here you can see a lot of what we have spoken to thus far as we talk about coming back to the mean. Obviously, these are trend lines that we're going to want to continue to watch. So everything can feel worse or more extreme when you're in that specific time. Yes, we have seen vacancy tick up slightly, but vacancy is actually returning to more normal levels after what we saw for household formation during COVID. The same can be said for rental increases and income growth. Let's go on to the next slide. One of the things that we watch, especially if you're investing in A and B class properties, is where your residents can go. And as you look at interest rates rising, yes, we monitor that for the debt on our own properties. But one of the things this has done, and it's actually impacted one of our properties in Louisville, the Rye, and we'll speak to this a little bit later on, is that it rises the rate and it makes it more difficult for that first-time home buyer to be able to leave an apartment and go buy a home. And that's what this graph is showing you here. So if you look down as it progresses quarter by quarter, what the increase is in overall debt service for that first-time home buyer relative to their income growth. And so the translation for this is that it is pushing people back into apartments. These are people who have had income growth and are willing to invest in where they live, but they simply cannot qualify for a home loan. Let's go on to the next slide.
Yeah, that's pretty telling when you have, 65.6% year over year, Q3 of 2022. That's a big number.
Mm-hmm. So as I mentioned earlier, that's just a little bit of a focus on the multifamily sector and what we're seeing there. And now I'm going to kick things over to Drew, who's going to put this in a broader economic context for us.
Cool. Thanks, Matt. So those of you who joined my lunch heard this earlier, but there's an old phrase that says, if you want 5 opinions on something, ask 2 economists. And so the idea is that there's a lot of opinions and no one really knows what's going to happen, but we do want to provide you some interesting data points that we think are relevant for our investors, for our market, and just kind of some keen observations as you think about where capital can go and where the economy might be heading. Trying to get a little bit, try to get my head around here. Let's go to the next slide on that. Yep. Okay. The historically investors, when they invest their money sort of mainstay stocks and bonds, the historical 60-40 bond equity to bond portfolio has been one of those things that you've heard financial planners say. It's sort of like the home base for a lot of financial planners. 60% of your dollars goes into equity, 40% goes into bonds. And this chart here shows that in 2022, both bonds and equity, right? The bonds is going to be on the vertical column and your equity is going to be in your horizontal column. Both were 0 or both were below 0, right? So that 2022 that circled means that it was the single worst performance ever by a 60-40 stock bond portfolio. As equity markets contracted, considering potential economic risks, as the same time that interest rates rose, those interest rates rose and bond valuations came down. And so there really wasn't any places to hide here in 2022. Investors really felt that strongly. And you can sort of see why that this is kind of recommended, right? Because very few data points are in that sort of southwestern quadrant. Everything is either north of bonds or to the right of the equities, where you're still going to get some offsetting returns. So this is where we find a lot of our investors are sitting, where there's really hasn't been a place to hide in 2022 in terms of total general sort of mainstream investment markets.
I think of the phrase, what a long, strange trip it's been, when I see that slide, just how unique 2022 was.
It was amazing. Unless you were heavily invested in oil and gas, I think that was about the only thing that actually sort of performed well. This is a long run perspective looking at the consumer price index going back from pre-1970 up until today. The shaded bars on this graph represent times of recession. So if it's shaded, you can see that's when a recession happened. Now, if you move all the way out to where we are today to the right side of the graph, you can see that they don't have a shade yet. And one of the things that some people don't realize is that when there's a panel of economists that are assigned to go back and look at historical data and then determine exactly when recessions happen. So it is possible that we're already in a recession, but we won't know that for 3, 6, 9, 12 months until that panel goes back and reviews data and will pick a data point. So this could be revised in the future. I think it is striking to say that based on historical, certainly within the last 30 years, we've had the highest level of inflation that we've had, aside from times in the 70s and 80s. But we do know that during recessionary timeframes is when we get some of the biggest changes in the federal fund, in the consumer price index, right? The big ramp ups tend to drive and push economies into recessions, or it's certainly a one of the functions of the components of it. This is an interesting data point, as when you look at the performance of the S&P 500, there are, I think, 8 or 9 different, on the left-hand side there that says peaks and troughs. These are little narrow windows, 1 to 2 years or shorter, that shows a certain percent decline in the S&P 500. So these would be the largest pullbacks over the last 60 or 70 years. And what those percents decline are, right? So the top one is negative 27%. You see some negative 20s. The most recent one, right, from January of 2022 to September, we saw the S&P pull back almost 24%. The point of this slide is to show that at each of these troughs, at each of these timeframes, when the S&P has pulled back, the next 1, 3, 5, and 10-year returns tend to be really strong performers, right? And so while you're in the middle of a trough, investors have a lot of anxiety and pullback. these are the points in time when you want to have your capital invested, because you're likely going to be rewarded by putting dollars into the market when you see these pullbacks. Certainly not guaranteed, but history has played out that these times of large pullback, those who continue to invest and stay in the market do get rewarded for that patience. I think earlier this week, Goldman Sachs had put out a report that looked at professional economic forecasters. And the point of this report was that right now we are at the highest percentage of forecasters anticipating a recession, right? So there's been other anticipatory times, but in terms of percentage of people anticipating it, it's already the highest, which means probably most of the investor sentiment has been baked into what is currently happening in the financial markets, right? Talk a little bit about credit markets, where we spend a lot of time operating in. Loan maturities, specifically with the multifamily space, we're going to see a lot of loans that are going to be maturing from 2020 up through 2024 as we're really going to have a peak. And that could present some great opportunities for debt that was previously taken out under lower interest rates is going to be recycled. Investment groups are hopefully going to be hitting their return targets, and we're going to see some volume in the marketplace. So those loan maturities, I think, are an indication of potential volume and buying opportunities. This doesn't mention any sort of distressed assets, and some of the apartment space has been starting to hit the news here, right? Folks that got loans with no caps and no reserves. You're seeing some major operators starting to default for those that didn't manage the risk well and assumed that the good times would always continue to happen. So loan maturities are going to continue to happen, and we're going to want to be prepared for those opportunities as those assets start to come onto the market.
Which actually, recently I heard a statistic of default rates were almost zero because there was, that during COVID, the government basically stepped in to provide liquidity and allow the lenders or really almost force the lenders to not be aggressive. But the foreclosures in apartments and the defaults in apartments are still at very low levels. And I can't recall the exact amount. I wish I would have written it down, but it's a very, very low amount. And traditionally multifamily, especially larger multifamily, just has a very, very low default rate. I mean, I'm talking less than 1%.
Yep.
Truly default. So.
Yep. Mortgage rates from a historical perspective, going back to the early 70s, are simply approaching what is pretty typical, a normal amount. And for the last 40 years, we've seen a pretty regular decline. There's you can see a pretty good trend line there as it sort of moves down over the last, 30 or 40 years. Only recently have those interest rates started to kick up, right? One of the amazing things that we talked about earlier today was that it really hasn't impacted housing prices. If you remember the slide a few previously, housing rates haven't adjusted from these rise in the interest rates. Part of it is that so many people over the last 10 years have financed or refinanced into low interest rate loans that it simply doesn't make sense to sell their house, because they could sell their loan at, if they had to sell their house that currently has a 3 or 4% interest rate and have to get into something at 7 or 8%, it creates a restriction in the supply. So that's why we sort of see this amazing thing where interest rates are rising and single family homes are continuing to rise as well.
I think this is interesting, Drew, and I like your input on it. When you look at this chart here, you can see obviously it starts from 1971, which is, I don't know why that's a date that it started from, but random date it started from. But obviously we can see interest rates are, hit above 18%.
Mm-hmm.
And so it says average since 1971 is 7.76%. But if you look at, and most people, when they get a home loan, for instance, they're getting a 30-year fixed home loan. So if you go back 30 years, our average is probably closer to like 4.5%, 5%.
Mm-hmm.
And so I guess I more of an observation, but maybe your thoughts on, would you look at the data point from like 1971 to, basically 1990, or would you just go, hey, that was kind of an anomaly maybe, and inflation was really high. That was an anomaly. What do you think there?
I don't think that 70s are comparable
Yeah.
in terms of the marketplace. I think there are different tax incentives today than there were before. There's a lot more home ownership got really brought to the forefront back in the 90s. That was really a driving force as to create home ownership. More liquidity and financing options have come forward. And there's simply more housing available, right? And so that has become a big change in the marketplace. So it's hard to compare. I'm not sure that the markets are exactly the same back then. It seems unlikely that we would get back to a number that looks like that. There's simply too much economic and political pressure to sort of see a repeat of that.
Yeah, I feel like if you look at modern times, so going back, let's call it 20 years or so, 20, 23 years, so 2000 and beyond, you're looking at, again, 4.5%, maybe 5% is close to your average. And we always love to go back and look at history, which is definitely interesting. But you have to remember, so much has changed, just especially in the financial market, where we're a world economy, where we weren't back then. The 401k didn't exist. Private equity groups weren't buying real estate, especially private equity groups weren't buying single family real estate. I mean, there's so many changes that have happened over the last even 10 years, but especially since 1970. So interesting data points to look at. But
can you go back just on that, go back 2 slides real quick to the slide about the S&P 500 there, because I think it speaks to what you guys were addressing. Drew has hit on this before and says it well. My biggest takeaway when I see this, especially as we talk about things in historical context, one of my favorite things that I keep coming back to is really twofold. One, the only thing constant is change, and then history is one damn unprecedented event after the other. So I think there is a real easiness, or it's very natural to feel like whatever period you're in is going to be the period or the way it's always going to be, right? So when times are perhaps difficult in an economy, when you are in a recession, it's easy to look around you and assume that it will be this way for the next 10, 15, 20 years. Now, the flip side of that can also be true. It's easy to think that, oh, I'm always going to be able to push rents without doing anything to my property. I'm always going to have a demand. This tree's going to grow to the sky. And that's simply not the case. And so as I look at this, and I've heard Drew articulate that in the past, it's really formed the way I think about where we're at now, and how I think people have to think about economic history.
Well, and how you need to think about how you're underwriting and looking at your properties, how you're purchasing your properties, certainly plays into that. Just exactly what you just said. We have to think about the long term, not just what's happening right now today. If it's easy right now, it's not always going to be easy. If it's really difficult, it's not always going to be really difficult. We have to look at those and take some lessons from them, but we have to understand that's not going to always be the case.
We also have to understand there are things way beyond our control, as we're trying to show here.
Yeah. Yeah, Drew, any thoughts on this? This is your area of expertise. So
manage risk, do everything you can to manage risk. Absolutely.
Love it.
We had a question that I want to address here with this chart. When you look at the capitalization rates, apartment cap rates for the last 20 years, they've been slowly trickling down, right? If you would have bought in the early 2000s, they were at 7-8%, and you sort of see them kind of trickle down. They tend to follow the 10-year a little bit, because you're anticipating a return above if a sort of a risk-adjusted premium above a 10-year, right? If you think of that as a risk-free investment, and you want your apartment rates to be somewhere above that, reflecting that incremental risk. This has really created a lot of wealth in the multifamily space, because the attractiveness of apartments has gone up. Management of these kinds of assets has gotten much more efficient. And when you can get more efficient, you're willing to pay more for those kinds of dollars. The tax savings, even the Tax Act in 2018 really pushed a lot of that bonus depreciation, and that's something that continues to get renewed. So the attractiveness for investors into this asset class has provided a continued compression of cap rates, which drives value. That's great for us in some ways, right? If you're able to, one of the examples I give is, if I can create an extra $100 incremental profit for a property. Well, if it at a 10 cap, that $100 of profit translates to $1,000 of value. However, if I'm in a 5 cap, that same $100 translates to $2,000 of value, right? So it makes the attractiveness for incremental value creation much higher as cap rates compress. So the question is, what are happening to cap rates today? And I think across the board, from what we're seeing in terms of valuations where deals are closing, from folks who work in the marketplace, is that cap rates are starting to go up just a little bit. Many buyers are only going to be, and we're doing that as well. We are only really making offers on assets where we can get 65 to 75% loan to value fixed rate debt products. Now, a year ago, trying to buy something that cash flowed day one at 60 or 70% loan to value, you would have been laughed off the map, right? That no one would have even considered it. But today, because of where the financing and the conservative sort of look into these markets, we're getting looks, right? So we're getting much closer to strike prices using more conservative financing structure, which in turn implies a higher capitalization rate on these assets. So we are starting to see them tick up a little bit. They certainly haven't spiked. In certain markets with certain assets, I think Matt would tell you, there's still a dozen or more offers will come in on attractive assets at competitive prices. So we know there continues to be interest in the marketplace for these kinds of properties, given the long-term profitability and the tax benefits associated with it.
Yeah, and data is always backward looking, like we already mentioned. So the data right now from like RealPage still shows that cap rates haven't expanded, but the data from real time, talking with brokers, and look, again, depends on what broker you talk to, but talking with brokers, the data are there, thoughts is, hey, cap rates have expanded, and I've heard anywhere between 25 to up to 75 basis points. I think it's going to depend on your market, your asset type, all that kind of stuff, but they certainly are going up. One thing I think that cap rates have some staying power on is because, again, like times are different, and you always you hesitate to say times are different, but we've got a lot more equity in the market than we've really ever seen. Multifamily and just commercial real estate in general has become easier to trade and more accepted as kind of an alternative asset than it was, especially back in like the 70s and 80s and even into the 90s. And then more people around the world. We're a global economy, so more people around the world are buying U.S. based real estate from all over, from China, from Germany, from Canada. Canada's I think right now is our biggest foreign investor, where Germany just a year or two ago was, so ebbs and flows, but you're getting money from all over the world investing in US based real estate. So that is going to provide staying power for cap rates. Not saying they can't go up, but I have a hard time believing we're going to see cap rates into that, 8 type percent. Unless you're in a distressed and a kind of a C class, type of asset.
Yep.
So, all right. Well, I guess I just took over your spot anyway, so I'm going to continue. Right.
Let's do it.
All right. So we'll dive into some of our 2022 acquisitions. We're going to talk about some of the markets we're in, why we're in those. And then the last little bit, we're going to talk about where we think things are going in 2023, dive more into that. And then we have some Q&A. So just want to let you know the flow of this. So the Rise, our first acquisition, this was a 228 in Louisville, Kentucky, where we raised just over $11 million. Occupancy is a little lower on this one. It's 85%, but we're doing a bigger value add. I think it might be higher than 85% right now, but we're doing a bigger value add on that property. And so this property right now, we've done a bunch of roofs. We've done all the windows, patio doors, landscaping, overhaul. I got a pool operational that hadn't been operational for like several years. So the residents are excited about that. Of course, we get it operational and then it's too cold, so we had to shut it down. But they're going to be excited in the spring when it's back up and running again. We put some amenities, some small outdoor amenities in place. We put some cornhole pads in where residents can play that, and expanded the playground area and dog park. painted the exterior and then interior renovations. We are doing kind of a full interior overhaul where we're putting in new cabinets and countertops, LVP flooring, redoing the bathrooms, not new lights and all the fixtures, and of course paint. So that's kind of our general rule when we're coming into an apartment. We want to look at what's maybe outdated. We just want to provide some updates because, look, every like 10 years, things become outdated. So this hadn't been updated. Most of the units hadn't been touched for many more years than 10, 20, 30, some of them like more original than others. But so we're doing that. We had a little bit of a slow start on those renovations, which typically seems like always takes place to just get the interior renovations off the ground. A lot of figuring out materials and working with the contractors to get all that off the ground. But right now we have completed 60 interior units, working on 13, should have 13 more done fairly quickly here, and just continue to push that forward. So I think the biggest kind of success on this one is we are hitting our pro forma rents and we're leasing these units out very quickly. So we had 18 new leases signed in January. January traditionally is a very slow month. Traditionally, you're going to have to potentially drop rents or offer some pretty big concessions. And we've been very successful to be able to lease out in January. And so we're looking forward to February, and especially looking forward to March and April and May, where hopefully and likely, as long as this trend continues, we'll be able to raise our rents above pro forma and be able to provide some pretty good cash flow into the property. So any thoughts on, if you guys have, Matt and Drew, if you have thoughts or something I missed, go ahead and jump in. But the Pops, that's the next property we purchased, 96 units, Lexington, Kentucky. So just an hour away from Louisville. That one, just about a $5 million raise. And again, we're hitting pro forma rents. This one started out pretty stabilized. So we're sitting at 90% occupancy and hitting good rents. We actually were hitting above pro forma rents for a while and dropped that down just winter months, and expecting again that to be able to raise back up above pro forma rents. We've completed all the work. That was pretty minor renovations. So we painted the property exterior, did some roofs, landscaping overhaul, just some other minor things with the amenities and stuff like that. So fairly quick, easy exterior renovations, make it a lot nicer, just to the eye. But the interior had all completely been renovated, so we didn't really have to touch the interior, which was a massive bonus. This one, we were able to pay our investors right away and we'll continue to distribute money to our investors every quarter.
For those of you that have heard the story, this is the property that we purchased from Mitt Romney. Or at least that's what we say. He was the equity behind the deal.
He was the equity behind the deal. So another asset in Lexington, Kentucky. So again, these assets, so we made a very we made a decision. We're only going for quality assets. We're focusing on location, excellent location. They got to be, B class or better, really. And so, sold some C class properties, got those out of the portfolio, and now we're just focusing on these A and B class located properties. And so this is another one, 124 units, total raise, 5.4 million. Occupancy, we can't get the occupancy down on this one. We'd like to lower that down a little bit, but nobody wants to leave.
The turn units. We want to lower to turn units because we're getting great.
Not just to kick people out, but we want to be able to get more units renovated. We just people want to live here and they want to pay the rents. And so we're getting anybody, people that are staying here. The only way we're getting new units turned over is we've got people transferred from one unit to the other to pay the higher rent because they love the place, they want to stay here, and they love the new renovation. So they're like, hey, we'll pay more money. We want to stay here. We want that unit instead. So, so you can see the increase in rents there. Studios 639 to 850, 745 to 1050, 846 to 1250. So you can see we're getting pretty good rent bumps on that. We had to redo a lot of the sewer system here. That was definitely a fun little chore that we had to do. but we're able to get the seller to help us out with that. So we were able to get that done. We're working now a lot on the exterior simultaneously with the interior unit. So we've completed 9 units. We did purchase this one in the fall. So we've only completed 9 units. Like I said, we're trying to get more units to be able to complete. But those out of those 9 units, a couple of them just came up, but 6 of them leased. They leased right away. We're expecting the other 3 to lease pretty quickly as well. But exterior wise, we're doing, the concrete and the landscaping. The finished landscaping will wait until the spring, but a lot of the decks and exterior wise, and we'll start paint the exterior as the weather warms up in the spring as well. So. And then the last property we closed on was Times Square. And this is a little different. Obviously, you saw the previous 3. And if you know Endurus, you've seen that we've pretty much, as Endurus, is closed on mostly multifamily. And this one was a retail building. We partnered with Obsidian Group and Mark Robinson and really are excited about this opportunity. Retail, if you're not familiar with retail, a lot of people think retail apocalypse. Everybody's leaving retail. Amazon's taking over the world. Nobody's going to shop at a retail center ever again. And so a lot of people are scared of retail, which is good for us because that kind of sentiment makes people nervous about investing in it. However, retail is doing extremely well. And it's retail that is 2 things. It's extremely well located, right? Which is everything we talked about already. That's what we want. We want the best locations we could possibly get. So this piece of retail is extremely well located. We've got a ton of cars driving by this, being able to see this every single day. So high traffic. That's one thing. The next thing is we want a variety of tenants here. So we have a great variety of tenants. It's not just the same tenants where you have to go in and you have to shop there. We've got experiences. X Golf is there. They're opening their kind of flagship store, their Twin Cities flagship store. This is, so that's an experience people can go to. You've got Warner Stallion selling appliances. Well, people always need appliances. I don't think that's going to go away. Most people want to see the appliances, understand them. It's hard to buy an appliance online. Auto parts store, right? Again, most people are going to go to the auto parts store. They need to talk to somebody to understand what they have to buy. Liquor store. A lot of people like to drink. So that's pretty safe, especially when a recession happens, they drink even more. So that's a recession proof business. And we saw it was a COVID proof business because it was a necessity, right?
Especially when the city owns it, like they do here too.
Yeah, that thing ain't going away. And we're excited for some new tenants that are coming in. So one of the things is this was very underutilized. The rents were extremely low. And so we're already seeing the benefits of being able to come in, reposition this property. We haven't really done any work, but we've showed our plan of the work we're going to be doing. Everybody's super excited about it, and they're willing to pay us a higher price. So current tenants have renewed, and they've renewed at our pro forma rents. You could see Tide Cleaners, Liberty Tax Advance Auto renewing at the higher rents. We've got conversations with a few others that looking at renewing. We've signed new leases at much higher than pro forma, $26 per square foot. We've got an LOI at $20 a square foot. And like I said, X Golf is opening soon. We're working with several national credit tenants that are looking at doing ground leases. We didn't even underwrite that in our pro forma. We knew it was an opportunity and we were looking for that opportunity, but we didn't underwrite it. So if we can get even 1 ground lease, which we're actually looking at potentially having 2 ground leases, that will just absolutely blow up the profitability of this opportunity. So we're really, really excited for, this retail center. We're looking for others, but again, they got to be extremely well located. They got to be the right play. Otherwise it just doesn't make sense for us. And we're looking at other opportunities, and I'll probably, we'll maybe dive into those as well. But, I think there's other segments of real estate that are very solid and could be very profitable. So as we look for different opportunities, we don't want to just grow to grow. We want to grow strategically. So as long as it fits into our box, we love storage and industrial. We love some of the retail and just other opportunities around, and of course, multifamily. But we're always continue to look to expand. So hopefully the story is to be told on all 4 of these properties, but I think good things are ahead for all 4 properties, and really excited to see what 2023, 2024 and beyond serves for these properties. All right, Matt, I'm going to hand it over to you. You can talk kind of about the markets. You've been spending a lot of time in these markets, and so let our investors know a little bit about what we're looking at. And maybe why too, because I know a lot of people on here, Matt, are, we got quite a few investors, but we also have some people that are just here to learn. So maybe why we're looking at a couple of these markets.
Absolutely. So what I want to do is touch briefly. I know we're getting a little bit long on time, and we can certainly follow up afterwards with Q&A, but we get a lot of questions on where are you looking and why are you there? And so we like to look really for 3 vectors of growth. We want to see population growth. We need people to live in our properties. We want to see job growth. We want people to pay rent, ideally with private sector jobs there. And then 3, we want to see rent growth, right? We want to see business cases that have been proven out. And so, Todd, why don't you advance the slide here and we'll get into some of the market fundamentals that we're looking at. We have done a lot of work. We started working together in Memphis, Tennessee, and people are like, well, how'd you pick Memphis, Tennessee, or Lexington, or Louisville? And I'd love to tell you, we were so smart. We ran all of these different analyses, but it was relationships that brought us there and encouraged us to dig deeper. And you get to a point where, hey, I know a lot about these markets. I can find sources of truth here, and I can feel confident in my underwriting because of the time I've spent here. And then I can build on, much like a supply chain of, hey, I can build around a property management company and contractors that I know understand and how to source labor in these markets. And so I can then direct their efforts. So speaking to one of the vectors as we talk about now where we're focused, thinking kind of that South Central Midwest area. True, these areas aren't going to be Florida or the coast, but we see good predictable growth here in populations, and that's translated into rent growth here. So let's go forward to the next slide.
By the way, we're not underwriting those rent growth projections, but that's just the projections that are out there in the market. So we'll see what happens with those. We're not underwriting those.
Todd's grumpy enough when I bring him new deals to invest in. I think if I brought him 9% rent growth, I'd have a mark on my face.
Yeah, I make it hard on that. That's for sure.
Looking specifically at Lexington, we have history here. We've seen deals go a full cycle. We like the fact that Lexington is affordable. We like the fact that there is a diverse economy. No one sector taking up more than 16% of the overall job. So we're not reliant there. You're centrally located too, close to other large population centers. It's actually Toyota's largest plant in all of North America. It's really fascinating that it ended up in Lexington, Kentucky. Let's go on to the next slide. So Louisville, as we touched on with the Rye, where we've seen some really phenomenal rent growth here, Louisville benefits from being a logistics hub. You've seen UPS, you have Ford that is rapidly expanding its plant there. Some pretty phenomenal job growth numbers out of 2022. Initial estimates are that it's 15% job growth last year. And so we can serve a population there. If you think back to how we're looking at multifamily, you have people that have capital that they can afford to invest in where they live, but they can't afford to go buy a home. And so that's pushing people into properties like the Rye here. Going on to the next slide.
I think this bottom number 6, it was, I think that was UPS added 800 jobs.
More Louisville added more than 800 jobs.
I think that was, I think it might have been UPS. I can't remember what company, but that got deleted on accident. So
Columbus, Ohio is a market that we've looked at for some time. It's got close proximity to our other target markets. We have had investments go full cycle in Ohio. For any of you that follow the semiconductor industry, Columbus, Ohio is the epicenter for semiconductor investment, particularly Intel, which is really the US's strategy to keep up with the world's scientific advancements, which is really through the semiconductor industry. So we are really excited about what we see here. And there's a number of other large employers that drive growth. And we have a lot of confidence that they're going to be around for a long period of time, on top of being an affordable place to live that is looked upon really favorably by the younger generations. Going on to the next few slides here. We have experience in Tennessee. We've spent a lot of time in Chattanooga, and then the next slide at Knoxville there. What's really fascinating about these two markets is that you'll hear a lot about Nashville and you'll hear a lot about Atlanta. But what's interesting is that these two areas are where you are seeing that growth domino, and you are kind of able to ride the tailwind. So in Chattanooga, for example, you can live in Tennessee, you can avoid paying a state income tax, but it is very common for people in Chattanooga to commute to Atlanta. So as Atlanta has grown, as Atlanta has gotten less and less affordable, Chattanooga has been a strong beneficiary of that. The same can be said of Knoxville, from Nashville there as well. Good, whether it's the University of Tennessee or Oak Ridge National Laboratory, other private companies or public institutions that drive employment that you have a lot of confidence will be there. Knoxville, we get excited just from our market trips. You can see the civic investment in the city. And what I mean there is you see a phenomenal amount of road work when you go through. So you can tell that they are planning for future growth here. And because we are bullish on Tennessee, we've seen strong population growth there. Knoxville and Chattanooga are two other markets that we're looking at.
Awesome. All right. So, we're going to wrap up here. Final thoughts. We'll hit some Q&A. Appreciate everybody. I know it's long, but hopefully you've gotten some good information from us. So final thoughts. I mean, I got a lot of thoughts. I probably could spend another hour just talking here, but really in 2023, that's what I want to focus on. Matt and Drew, I'll let you guys add on, but I think 2023 is going to be an interesting year. I think 2023 also could be a year of like almost 2 years, right? So I feel like the first half of 2023 is going to be a lot of discovery. We're seeing as far as real estate discovery still happening. There's deals out there still, but there definitely is this gap between the sellers and the buyers. And the buyers are saying, hey, we need to be here. And the sellers are like, hey, we need to be here. And there's this gap, and we're going, okay, who's going to win right now in 2023? And so I think you're going to see a less transaction volume in the beginning, kind of half of the year, and probably that pick up as the year goes on and continue to go. Now, is there going to be amazing opportunities in 2023? Are we going to see a recession? Or are we going to see like this real estate crash like we saw in 2008? My crystal ball says no, but my crystal ball probably is broken. So I don't know if it's, what's going on there. But here's what I think. Are we going to see a lot of crazy deals coming up? My guess is there's going to be some deals. But if you're an investor, if you're out there looking for deals, I think the people that are going to get the deals are well-established companies that have built solid relationships in the industry. And if you're like, hey, I'm not a well-established company, well, then start right now building really solid relationships in the industry, building relationships with brokers, with lenders, with property managers, and really just dive in and lean into that. I think where we're excited is we have built those relationships, and we're continuing to work those relationships. We're continuing to monitor deals. We're underwriting a lot of deals between Matt and Zach. They look at a lot of deals every single month, and we're continuing to underwrite that. We give our brokers feedback. And so they're able to say, okay, Endurus is ready to buy. We just need to bring them the right deal. And will these great deals come? I don't know. It's hard to say, but we're ready if they do. I think there's a few things that say the deals could come. We talked about the loan maturities. There's a lot of loan maturities that are happening, and some of those loans may need an injection of capital, may need a new GP to come in and take those loans over. So that's an opportunity we're kind of looking at, definitely keeping our eye out for. We haven't really seen that yet, but there might be a need for injection of new capital. You're essentially going to step and wipe out the GP and potentially the LPs, or at least lower their share. But that might be an opportunity to come in. So we might see some of that. Rents are certainly softening, but I don't think they're falling off a cliff. We'll have to watch to see if leases become inverted. And by inverted, I mean, the new leases are actually cheaper than the existing tenant base is paying. And so we'll see how that plays out. But I think right now we definitely aren't seeing that. Supply is big in some markets. And so one of the things we're trying to stay away from is markets that have massive supply coming out into the market. You look at I love Nashville, Tennessee, but if you look at Nashville and how many units they're building right now, it's far exceeding their historical norm. And it's far exceeding just even their records. You look at a market like Phoenix. When Phoenix crashed in 2008, they were putting in 10,000 new multifamily units a year. Right now, they're putting 40,000 new units a year. We're looking at markets like that as, hey, that might be a potential opportunity because we feel that's long-term growth. But we're looking at those as an outside looking kind of like, hey, what's going to happen there? That could be opportunity, but we're not in those markets right now. This could be something to look at. So we don't want to push the trigger unless those markets really take a big dive, because we know with just the general economy that they'll take a big upswing. So we are looking at markets like a Phoenix, like an Austin, like several others kind of around the country that definitely have good indicators, but right now maybe sitting on a bubble.
Hey, Todd, we have a quick question here. Paul says,
Yeah.
do you see some deals coming out in first quarter, or what's our time horizon? Do you think what's Endurus's goal? Where do you think things are heading?
Yeah, well, I mean, Endurus's goal is definitely to buy some deals, and we are hopefully going to be buying a deal in one of our target markets. We still have a little ways to go on this deal, but we're hoping to be able to announce that we've got a deal that we'll be bringing to investors soon. I don't want to give too much detail away just because we're definitely in early stages on the deal right now. And we're optimistic that it's going to happen, but it fits our criteria. It fits everything that we're looking for. It's extremely well located. It's in a great market. It hits our deal metrics. We will be able to get good financing on it. So there's still obviously discovery to do, but that's definitely a deal that we think will likely hit. And we got a couple others that we're looking at that kind of hit those same metrics that we think have really good opportunity to hit. So
another question here is the goal to focus more in the multifamily area or open to all options to increase investor returns?
Yeah, I would say we are and this is getting into some goals. So I'll actually go to that slide there. So got a little spell here, but that's okay. That's what happens when you try to go fast. So I would say we are focused on acquiring $100 million worth of value add commercial real estate using long-term fixed rate debt. So again, high quality, right? Value add, solid debt. Those things we feel are going to be very powerful moving forward. Now, what happens if the economy goes through a recession? What happens if rents do go down? What happens if all the bad things that people are saying, what happens if they all happen? Well, that's why we're looking at these things, because our investment, we might not hit pro forma, right? But we are still going to have returns to our investors. We are still going to return capital. So when we're looking at investments right now, especially, but always when we're looking at investments, we look at how are we protecting our investors' money? And we won't look at an investment. We won't move forward with investment unless we feel like there's 100% probability that we're going to return investors' money. Of course, 100% is never, truly the case, but we want to be as close to that 100% as possible as we look at any deal. So to answer the question, multifamily is always going to be our bread and butter. I don't see that changing, at least right now. That's not in our vision to change. Multifamily is our bread and butter. But are we looking at other opportunities out there to continue to grow investor returns? Absolutely. Returns are definitely one of our biggest focuses. our big focus, but also, again, we want to make sure these are good, solid investments. Because one thing I've learned, Matt and Drew have learned over the years, is something on paper can look really, really good and sexy. I can give you as an investor a pro forma that shows you're making 40% if I really wanted to. I could go look at this property in this horrible neighborhood that's got this great quote unquote story, and I can make that deal look really, really good. And by the way, I'm not even lying. Like, it's just, I'm fooling myself. But when push comes to shove, can I actually perform on that asset the way I think I can? And we've found through the years that it's typically not going to happen the way you expect it to. So if we can take out some variables, take out some risk, we're going to get closer to hitting a pro forma. There's one thing I can guarantee: we're never going to hit a pro forma. We are hoping that we're going to hit higher than the pro forma. That's what we're working really hard at, is trying to hit higher than the pro forma. But I can guarantee you we're never going to be perfect on our pro forma, because we just don't know the future. So our goal, acquire $100 million. Last year we acquired, so in 2022, we acquired about $80 million worth of real estate. That's the acquisition plus the renovation. It was about $80 million. And so this year, 100 million, again, commercial value add, and with solid debt and in solid markets and solid locations. The other thing is we're really focused on asset management. And I think that's really important. If you're an investor, if you're a company like us, or maybe you're, a smaller company, but I think it's extremely important right now, especially as we head into a looming recession, and uncertainty. By the way, there's always uncertainty in the market. But as we sit here and we're going, hey, we might be heading to recession, as Goldman says, everybody says we're heading to recession. The biggest thing you want to focus on is asset management. And so that was one of the reasons we brought on Daniel Simpson. We want to continue to renovate our properties and bring them up to 90% plus occupancy and really bang that out of the park, really do an extremely good job controlling expenses and increasing income. And so that's a 2023 major goal of ours, is we really want to focus on quality of our assets. We really want to focus on making sure we're doing our job in the company. So, and then focused on building out our systems and growing our team. We've grown our team over the last year, and we want to continue to grow that. Of course, strategically, really smart. We don't want to add people just to add people, but we want to grow our team in a way that makes sense, and really start to kind of think about the long-term growth of Endurus and what we want the company to look like. And so that's been a big focus of ours too. The last slide here is just long-term goals. And so where do we see Endurus going? Our long-term goal, of course, the goals always change, and they always get massaged. And so we'll see kind of where this goes, but our long-term goal is to really grow Endurus into, and the number really doesn't mean anything, right? But we want to grow Endurus into a company that can positively affect thousands of people. Right? We want to grow Endurus into a company that can really make a change in markets, really be a positive influence in markets, really provide excellent returns to a large amount of our investors. And so we want to be a leader in growth and change. And that's beyond the, we put the 10 billion, but that's really just a number to say, hey, if we get to that number, we feel like we can start to make a lot of change, and really before that, we can start to make a lot of change. But that felt like a good number. The vision is to vertically integrate as well our renovation, our management teams. So to start to bring some of that more in-house, to be able to control some more variables. Again, it's all about controlling as many variables as possible, or limiting the variables that are at play. And if we can do that, we can, again, mitigate a little bit more risks. We can hopefully be able to continue to provide excellent returns with our investors, and grow a company that fits our vision of impacting thousands of lives. Because now we have more employees that we can positively affect. We can really make it feel like a family and a company that cares for everybody that is involved. And the last thing is just continue to be a company that's focused on serving others and providing impact to our communities. We just want to make sure we lean in more and more to that. That's really important to us. Do we have any more Q&As?
Not yet. No,
Okay.
I think we've answered everything.
Okay, cool. Oh yeah, here's a couple of resident feedbacks. We're gonna hit it. We'll have a recording here. I'm not gonna read these out loud to you, everybody, so you can read these on your own time. So what I'm gonna do is, once we're done here, we'll get the recording all processed, and I'll get an email out to everybody so you can look at this. You can look through the slides, or spend some time through the slides if you want to look at any of those data points. But again, we're excited about 2023. We're excited about the challenges that it's going to bring. It's definitely going to bring some challenges to us, to many people. It's going to bring some challenges, but it's also going to bring, I think, opportunities. And with challenge comes opportunity. And we're focused on being able to hit those challenges head on and being able to provide or being able to grow our company and just continue to hopefully provide good services to everybody that we are able to touch and to be involved with. So, yeah, Matt, Drew, you guys have anything else?
No, thank you for those who joined us. We appreciate appreciate the time, and for those investors, we appreciate your trust with us. And we're working hard every day to figure out how to get our properties performing even better than they were the day before. And we're looking at new opportunities as well. So thanks, everyone.
Amen. Thank you.
Yeah, definitely. And by the way, I've got a ton of thoughts that I throw out on my podcast. So if you guys want to know a lot more of my thoughts, just tune into Pillars of Wealth Creation. Well, Matt and Drew, I got to get you guys on. We'll do two. I'll get like one of you each time, and we'll just go through I've got this whole note sheet here that we didn't even cover. And so we could just go through some of these and talk through some of these thoughts, because there's so much to talk about. And we already mentioned, like everybody's got thoughts on what's going to happen in the market. And you can listen to 30 different people and they say 30 different things. And you go, wow, they're the smartest people I've ever heard. They're going to be right. And then you listen to the next guy and you're like, whoa, that person's going to be right. And they said the exact opposite. Right. But we all have thoughts. It's just that what are we doing with these thoughts, and how are we mitigating risk, and what are we doing to move forward in a positive way? I think that's the most important part. So, well, cool guys, everybody. Thank you again joining us. And yeah, I'll get this out to your email inboxes.
Thanks, everyone.
Stop recording.
Yep. As soon as I can figure out how to. And